Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the show, my guests and I will cover every angle of real estate, from interest rates to the economy to what's happening in Washington. Anything that affects real estate in our local area, we will cover it here. If you got credit issues, you can call me. If you want to refinance to the lowest rates in U.S. history, you can call me. If you're considering short selling your home versus a means to avoid foreclosure, you can call me, and I'd be glad to give you the details, to set you up, to put you in a position to succeed with that short sale. You've got the questions, and I've got the answers. And make sure you join us every Monday at WNEW 1580 AM from 2 to 3 p.m. in the afternoon. Please call me with any questions that you may have. The off-air number is 877-245-2030. That's 877-245-2030. Or you can tune in via the web at realestate360live.com. That's realestate360live.com. We're waiting for your call, so give us a shout anytime. Remember, if it's real estate, it's covered here. Got a great show lined up for you guys today. Joining me on our panel to discuss what's going on in the markets is Louis Cammarosano, who is a general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to dissect with you what happened in the markets last week, as well as what's going on this week that can affect you and your real estate decisions. Obviously, there's a lot of things that can really push interest rates up or down, and we're going to break those things down for you. Louis, how you doing today, buddy?
All right, and yourself, Ryan?
I'm doing well, Louis. Thanks for asking. It's beautiful weather here in Virginia, or in Maryland, actually, where the studio is, but it looks like we're in the 78 degrees for this week at some point. So.
Spring training weather, huh?
Yeah, it's nice, and then we got the March Madness, which starts up this Thursday, which is known as the least productive work week of the entire year.
I'm sure you've got all your picks ready, right?
Yeah, I've got all my picks ready. Yeah, I'm trying to figure out how I can rearrange my work schedule so that I can watch the games on Thursdays and Friday as well. But I wanted to start out, one of the big things that we have going on this week, Louis, is on Tuesday, the Fed meets again, and they've been talking about a potential to actually have quantitative easing number 3. And you and I have kind of discussed that, we really didn't think that it shouldn't happen, but it looks like it could happen. And ultimately, what they're trying to do is they're trying to get long-term interest rates even lower, as if they're not already low enough. Now, I'm not sure, whether this is going to be the language that's used during this meeting, that's what their intentions are. However, I think it's important to note that, people that are out there shopping for a mortgage, that depending upon what they say, this could really move the markets up or down. And it's probably a very smart decision to consider locking in your rate ahead of this meeting. Just because, the Fed tends to be very ambiguous sometimes with what they're, the way they relay on information. And I have a feeling that QE3 could be on the table. Now, there's a lot of the Fed members that don't tend to agree with this. But there's been numerous people. I believe you actually had sent me an interview with James Grant, who actually had said that the Fed is what they're doing is essentially market manipulation, which you and I have discussed over, the last couple of months, that that's exactly what's going on. And that, we're not really getting an accurate reading on what's going on in the economy because of this manipulation. What are your thoughts on that?
Well, I think what's happening is, we have a debt problem. Debt causes price appreciation for assets that you have to use debt to buy. So if you look at the housing market, the reason home prices rose was because there were policies in place both on the government side and on the Fed side to keep interest rates low so everybody can buy a house. So that pushes the price of the house up because everyone has access to credit, so prices can go up. It's the same when you want everyone to go to college. Everyone can get credit to go to college, so the price of tuition goes up. So what's going to happen now, though, is, you've got all this debt out there, and the way they keep interest rates low is by quantitative easing and by printing money. So that means there's more money in circulation. And when you have more money in circulation, it takes more money to buy certain fixed goods that you don't buy on credit, such as gasoline, gold, and other commodities. And even though those products go up when there's speculation, when people speculate on credit.
Right.
So what's happening now is we were in a spiral or a circle where we just keep issuing credit and trying to keep interest rates lower by printing more money, and that's really they may accomplish keeping the interest rates low, but at the price of devaluing the dollar. And when you devalue the dollar, then you have to pay more for certain fixed goods and services.
Yeah, and that's it's almost like if people aren't. I mean, the media is not really recognizing this fact because they're still using the CPI number that the government puts out. But there's been articles, and I believe I spoke last week on the American Institute for Economic Research that actually says that the inflation rate is really probably more near 8% versus the 3% that's being reported by the U.S. Bureau of Labor Statistics for the Consumer Price Index at 3%. And, I've been saying this over and over again that, the biggest thing that's hitting people's pockets, especially right now, is gas prices. But, when oil's rising, the cost to everybody, the cost to do business goes up.
Right.
And that's going to be passed down to the consumer.
That's right. It's not just what you put into your tank. It's in the cost of the finished goods.
Absolutely. So everything that you're buying, the price of it's going to go up. And it might be nominal in certain instances. But what I told a lot of people is that, when you go in the grocery store, one of the things that's important to pay attention to is you may be buying the same product and it's at the same price, but the size of the product or the quantity of the product is actually being reduced to it's another form of like market manipulation, and the psychology that goes on with the pricing of those goods and services is that people think that they're getting the same exact thing, but it's not exactly the same thing as far as the size or the quantity of it.
Right. I've seen the 13 and a half size jar now, which I never saw before.
Right.
I think that's when you used to have it at 16 ounces, they now sell 13 and a half.
Right. Well, every time I go into the grocery store, Louis, I find myself walking out with double the amount of stuff that I really need. And I can't get out of the grocery store for most of the time less than $100 anymore. So, that's, I know, going to be a bigger and bigger problem as we progress, especially if oil prices continue to rise, which I think they will. Although, I think that it's interesting because there's been a lot of articles out there that Obama's approval rating, is tend to be sliding because of the gas prices that have been rising. But ultimately, I think as we approach closer to the election, I think mysteriously we're going to see gas prices go back down. But that's just my opinion. I don't know whether it's going to happen or not.
They'd like them to, but the only thing is if you do quantitative easing and there's more money in circulation, it's going to take more of those dollars to buy the oil. So I don't know how they're going to accomplish that other than, and they don't really have friends over at OPEC that they can put pressure on.
Right. Yeah.
That's kind of a hostile entity compared to the United States. They don't necessarily go along with what the United States wants in terms of pricing. I think the prices are really going up just because of inflation. Inflation is defined as an increase in the money supply.
Yeah, and we really don't. I think that this is something. We always talk about kicking the can down the road, and I think that the overall burden and the debt that this country is carrying is not sustainable. And instead of talking about cutting back on what we're spending, we'd rather just keep printing the money because it's easier to keep running this massive Ponzi scheme essentially, and keep doing this for an extended period of time. But ultimately, when we continue to do this and devalue the dollar, inflation is inevitable. Now, when that happens and everybody starts to really recognize what's going on for what it really is, interest rates will at some point rise dramatically and very quickly. And that's what we've seen go on over in Europe, right, Louis? I mean, that's the same exact thing. And we're in pretty much the worst situation of all the countries in the world right now.
Well, in terms of the total amount of debt, but if you think about what you see in the media, the whole debt issue was kind of passé now. You don't hear so much about it. We were sidetracked by the Arab Spring. We were sidetracked by the Occupy Wall Street. But the real critical crisis has been, and still is, that's looming, is the debt crisis. And that's kind of on the back burner now. That's not what occupies the 24/7 media cycle right now. Even in the presidential campaigns, that's not what you're hearing. That's not what the questions are about. It's not about how to get sustainable debt levels and how to get the value of the dollar up. Those are not issues that are concerning people right now. Yeah, even though they should be.
Right, and really the only big advocate out there talking about the things that you're suggesting is Ron Paul.
That's right, and they've marginalized him by saying he can't win, but basically his points of view are not accepted by the mainstream, and that kind of marginalizes his message as well.
Yeah, it was interesting because one of the comments that he had was to Chairman Ben Bernanke was, this argument that the prices are going up about 2%. Nobody believes it. He told U.S. Federal Chairman Bernanke last week during the hearing. People on fixed incomes, they're really hurting. The middle class is really hurting because their inflation rate is very, very much higher than the government tries to tell them, and that's why they lose trust in the government. But
even if you have a target inflation rate, that's also viewed as improper, because why would you say you're going to devalue your currency by 2% a year?
Right.
I mean, you're basically saying we're going to take that from you, especially if the interest rates are below the inflation rate, which means if you are a saver, you're going to lose 1% a year.
Right. And
they force you into equities and other risky assets, and that's exactly where they want you to be.
Yeah, and that's, you bring up a big point there for people that are looking to retire in the next 4 to 5 years. I mean, I'm sure that they're going to have to alter those plans because...
Well, they have to put money into 401, they have to keep their monies in their 401k plans and equities and hope that when they're ready to take it out, there isn't a market dip.
Yeah. Yep. I mean, they're having to take riskier investments to see that same rate of return. And, while the stock market has been rallying over the last month, and I think it really is a false sense of what's actually going on out there. I really believe that, as far as real estate concerned, because this is a real estate show. I mean, we you and I talk all the time, Louis, that, it's a great time to buy if the person is able to obtain a loan. There was an interesting statistic, and I believe it was from NAR, where housing affordable soars to a record high. And they have this index, and an index of 100 means that median income household has exactly enough income to qualify for the purchase of a median price existing single family home, but also accounting for a 20% down payment and a 25% of gross income devoted to the mortgage principal and interest payments. Now, I find that flawed right off the bat because I know the majority of people buying a house don't have 20% to put down, Louis. And 25% of the gross income, most of them is probably more towards like 35% of their income. So, I really do think that the housing affordability right now is at an all-time high, but really I think that it's the alternative is renting, and rents are shooting through the roof. So with that, with people having two options on the table, which is A, to rent and to not be able to lock in their long-term homeownership costs, or B, to buy and be able to get a 30-year fixed rate at sub 4% levels, depending upon their credit qualifications, it just ultimately makes more sense to do that.
Sure. Then you keep that monthly payment the same 2, 3, 5, 10 years down the road. It makes tremendous sense, especially if your time horizon for staying in the home is indefinite, or at least five years plus.
Right. And, I always tell people that, it is important to sit down and look not just, at the mortgage, but what your short and long-term financial personal goals are, right? And you need to factor this mortgage into that equation. A lot of people are just buying a home out of necessity now because it's cheaper for them to do that than to rent. But, a mortgage is also it's a forced savings account. So you are getting something out of this, other than just, owning the home and getting all the perks that come with that, being able to, keep your kids in a certain school district and not having to worry about moving every couple of years, making the home your own, developing relationships within the community. I mean, there's a lot of reasons to buy a home, but, I think that the media now is out there pushing that, affordability soars to record highs. In the Northern Virginia, Washington, D.C. metro area, I mean, we're having ridiculous bidding wars on homes that are priced, $500,000 and less. And it's really just because there's a shortage of supplies of homes on the market. And that's why we're seeing a lot more new construction selling at such a rapid pace, because people are getting frustrated that they're missing out on a contract on an existing home sale, and they're going over to buy a new home and paying, probably an additional 10% more than they normally would.
And those prices are attractive. I don't know if you know, but the San Francisco market, the average home price is close to $700,000, and they said that the average family making $100,000 a year can really only afford about 20-25% of the homes on the market, and most of those homes are in undesirable neighborhoods.
Yep.
So San Francisco's an anomaly, but nationwide and in the D.C. metro area, it sounds like there are decent bargains that you can pick up that make more sense to purchase than to try to hit the rental market.
Yeah, absolutely. We're coming up on a break. When we come back, we're going to let you know what an acceptable hardship if you're trying to short sale your home is. So stay right there. We'll be right back.